So today we are going to be diving into our main module that really highlights some of the different ways we can leverage different tax strategies. And we're going to walk through how we can use that to adapt to the case study we're going to be looking at today. And one of the key features there is we do have the flexibility needed to create customized and tailored tax strategies for each different type of proposal. So we're going to be looking at modeling multiple tax strategy proposals and some of the key comparison visuals and a couple of settings that are going to be important as we're navigating these conversations. Now, towards the end of this session, we're also going to be diving into the different resources that you do have available to you when leveraging RightCapital. One of those resources being that during this webinar, if you have any questions, please feel free to use the Q&A section to type out your questions there. More than happy to answer any questions you guys have towards the end of this session. Now, shifting gears into RightCapital. Today, we're going to be looking at a little bit of a case study. These are going to be pre-retirees, of course. And so before we dive into just creating different proposed strategies and the tax strategies, I want to first address who we are looking at today and better understand this case study. So we're going to be starting off under the profile section and under blueprint, because this is where we're going to see the nice visual summary of the client's current plan. Starting with the visual summary of their net worth, we can see here that they have a current net worth of $3 million. That includes their primary home, a couple of debts. And right away, we can also see they have a pretty heavy investment in the tax deferred bucket, which is going to be a really big piece of what we're looking at today, which is being more tax smart, either when we're looking at the strategies we're implementing, withdrawals, or a couple other ones. So this is going to be one of the first things we'll be noticing here. Now, the Baratheons are also in their late 50s. They do have 2 children that they're also concerned about, mitigating the tax burden that their heirs are going to be subject to by being more tax smart now. So it's going to be a concern that we're going to be addressing for this family and some of the strategies we're looking at today. Now, for their goals across their lifetime, they are planning on taking a family vacation next couple of years in 2027. And we also have them retiring at age 67 respectively, which is going to be an important factor to play a role into one of the conversations that we are having when it comes to their retirement and their income. So if we go to the income savings expenses section, we can see what they're getting in terms of current income, some pretty decent income coming in. And we also have them filing for Social Security at age 70, which already we can see that there's probably going to be a gap in terms of income since they're retiring at age 67. And then we have them filing for Social Security at age 70. Now, they do have some pretty decent saving habits currently, and they also have some pretty decent spending habits to note as well. Now, before we dive into some of the different strategies for tax strategies, one of the first spaces that's going to be really beneficial for us to review first is going to be found under the investment module. Now, under investment tax allocation, this is where we can see a nice visual summary of the client's current tax allocation. Now, this is just going to be an important piece of the conversation for today, because this is going to allow for us to take that step back that's needed, especially we're trying to paint the picture for the client as to what these different type of tax deferred, tax-free, and taxable assets are, and what it means when we're looking at tax smart strategies. And when we're looking at something like a Roth conversion, why are we looking at doing that? What does that actually mean? This is probably going to be the first place we're going to just paint the picture of where do we currently stand in terms of our tax allocation. So we can see here that they have a current taxable asset of $686,000. And the same thing for tax deferred assets, over $1 million in tax deferred. And we can also click into each of these to see a further breakdown. So we can see the examples that we have here of those tax deferred assets. Not surprising, it's the traditional 401ks and IRA. And we can also see additional examples of other tax deferred assets. Same thing for tax-free. We can see here what they currently have for tax-free assets. It's the HSA and the Roth IRA. And we can see other examples of additional tax-free assets as well. So especially if somebody doesn't already have any tax-free assets, we can also paint the picture of what those might be and different products that are out there. So it's just going to be one of the first spaces we typically navigate to help understand, especially with a client, what the tax allocation is and where we currently stand in terms of current tax allocation. Now, typically, once we have that better understanding, the next space we're going to be navigating to is going to be, of course, found under the tax module. Under the tax module, there's a couple of different sub-tabs here that are going to be pretty insightful pieces for us. But the main focus of today's conversation is going to be the tax strategies tool. Now, the tax strategies tool is going to allow for us to create a fine-tuned and dynamic approach when it comes to tax strategies with the ones that are available in this tool. So the main 3 tax strategies that we have available to us that we can start to leverage, we're going to find down in the action items. So before we dive into the visuals, I'm going to navigate down to the action items. And I want to address the 3 main tax smart strategies we have available to us specific to the tax strategies tool. So one of the first ones we have here is the asset location strategy. We also have asset withdrawal strategy. And also, of course, the very popular one is the Roth conversion tool. Now, to take a step back, I want to first define what each of these different strategies are before we look at implementing them, because this is going to be an important part of the conversation we're looking at when it comes to us trying to even implement them. So the first thing I want to talk about is the asset location strategy. So first, we're going to go to the summary visual, and we're going to change to the asset location dropdown. This is just going to show us how the current asset location is. So in general, when we have the asset location strategy, it's going to be taking that idea, and it's going to be granting you control over how a client's equities are allocated between the 3 tax buckets. Put differently, you can choose how the equity portion of the client's overall asset allocation is spread between the 3 tax buckets. So the default is that it's going to be a pro rata allocation. So it's going to be proportionally allocated across the accounts and across the account balances. We can see here for reference what the current portfolio allocation is, the split, 39% to 61% split for equities and fixed income. And we have the ability down below to indicate we want to take a different approach when it comes to equity allocation by essentially reallocating a client's equities to fill up each tax bucket in order that we have here before overflowing into the next. So equities will be reallocated proportional to the current dollar value within each bucket. And whenever we implement this strategy, it's a dynamic calculation that happens every year. So it will consider the fact that the buckets and the account values within each are going to fluctuate. We might be having shifts occur in terms of account balances, especially with some of the other strategies we're looking at today. But that's going to be what the equity allocation is. The next tax smart strategy we have available to us is the asset withdrawal strategy. And this is going to be taking that idea that in the event that we don't have enough income inflows to cover our outflows within a specific year of the cash flows, we know we're going to have to pull from our assets to fund those outflows since we don't have enough income to cover it. The asset withdrawal sequence is going to be determining which accounts we pull from first to fund those outflows. So for example, my default right now is that we'd be pulling from the taxable bucket to fund those expenses, those outflows. If the taxable bucket gets depleted, we then reference the tax deferred assets and then tax-free if all else is depleted. So this is going to be the withdrawal sequence we're taking when we do not have enough income inflows to cover our outflows and need to pull from our assets. The third strategy, and one of the very, very popular ones, of course, is the Roth conversion tool. So there's a couple different approaches we can take when it comes to the conversion target. The default is ordinary income tax brackets. And this is going to be the smart tool that allows for us to fill up the tax brackets via Roth conversions. So typically the default is ordinary income tax bracket, like I said, but from the conversion target, we also can change how we want to calculate those Roth conversions, whether we want to fill up the capital gains tax brackets, or especially if we have Medicare involved, we can also fill up to Medicare premium tax brackets as well. So we have 3 main options for how we want to indicate these Roth conversions. A really important thing that I want to note before we dive into something like the Medicare premiums is we'd want to make sure Medicare premiums are turned on. If they are turned on for this family, we will be considering the implication for IRMA, so income related monthly adjustment amount. That's all going to be considered and calculated in the system. We'll see those implications, especially when we're looking at something like the Roth conversions to Medicare premium tax brackets. But I want to first just touch base as to how we can ensure that we have the Medicare premiums turned on for a family, because we do with the Baratheons. So we're going to go to the profile section real quick. Under the goals section, once again, going to profile goals, the card that we want to make sure is used to determine that we want to calculate Medicare premiums is the annual retirement healthcare cost card. So when we click into this card, what we'd want to make sure is selected is that we have a detailed estimate selected for the cost estimate dropdown. And that's what we have selected for Aria and Gendry currently. And that would allow for us to then calculate Medicare Part B and Part D based off of AGI, and that's going to be considering the 2-year look back whenever we have this goal starting, of course. We also have the ability down below to indicate any additional out-of-pocket costs, post age 65, of course. But the main part here that's going to be important, especially for trying to navigate that conversation surrounding us incurring any sort of IRMA or income-related monthly adjustment amounts with Medicare premiums, we'd want to make sure we have detailed estimates selected in order to be effective in that planning. Now, we do have the option to turn off Medicare Part D. So if you have selected that and indicated not enrolled, that would turn off the calculation. So we'll be considering all those different nuances when it comes to the tax strategies as well. But navigating back to the tax module, under tax strategies, the final piece that's going to play a role into some of the conversations we're looking at today, and back on the action items, is the estimated terminal tax rate section. And this slider in particular is only going to impact the visuals and the conversation pieces we're seeing in the tax strategies module. So the estimated terminal tax rate is going to be applying a terminal tax rate to these ending asset values. And this is going to be that tax rate that the heirs are subject to when they inherit these assets. So if we recall, a big piece of the client concerns we're looking at today for the Stark-Baratheon family is that they want to ensure that they're alleviating as much of the tax burden as possible for their children. And this is going to be a part of that conversation. Right now, we have it toggled over to 22%. But if we're looking at the children's situation and we know they're going to be higher income earners, or maybe their tax rate's going to be a little bit lower, we can make the adjustments down below. But right now, I have it set to 22%. And that's going to impact some of the visuals we're going to see up above. But now that we have that understanding of what the different options are, now we're going to navigate to some of the other pieces of the tax strategies tool that can provide further insights before we determine the path we're looking at for the Stark-Baratheon family. So the first space I'm going to be navigating to is the calibration tab. Because under the calibration tab, this is where I can see the ordinary income tax brackets across the client's lifetime. And this is just beneficial to see where they are falling in regards to the ordinary income tax brackets. And we can see straight away, without even hovering over the chart, that there's a dip in the taxable income, which is not surprising because once they retire at age 67, we don't have them filing for Social Security until age 70. So there's a pretty decent gap there. And we also see a major hike in taxable income because we also have later on in life, RMDs kicking in. So we have required minimum distributions that are pretty heavy for this family post age 75. So one of the strategies we're looking at today is, of course, Roth conversions. We want to start to mitigate some of that tax burden. We want to also take advantage of when we have these lower tax brackets. And that's going to be one of the things we're incorporating in the conversation today. Now, some of the other key visuals we can find from here that can help us better understand the tax picture for this family are the key tax components. This is where we can just check in to see, what's happening in terms of those key tax components. How much is Social Security having a role to play in this? How much is withdrawals from tax deferred having to play with this? Not surprising, it's pretty high post age 75 for the tax deferred withdrawals. But we can also view the capital gains tax brackets. So if we're looking at conversions up to a certain capital gains tax bracket, this is going to be a beneficial figure to look at. And we also have a very important one, which is the Medicare premium tax brackets as well. And we can see once again that kind of dip that happens post-retirement for this family. But in this case, we're going to keep ordinary income tax brackets selected. And if we scroll a little bit further down, one of the other things that I also want to emphasize, because this is something that the client has communicated to us, is we want to also be able to have further control and refinement when it comes to us calculating the Roth conversions. So one of the things I want to go down to the action items to do is we're going to click on this edit button, and this is going to open up this drawer that allows for us to toggle on or off certain tax strategies. So for example, if we didn't want to talk about asset allocation today, we could toggle that off and it would remove it. In this case, we're going to keep it selected. One of the things that I wanted to tie in is the conversion start and conversions end date. Because especially in this instance for this family, we're looking to make sure that there's no Roth conversions calculated prior to retirement age for this group. So we're going to select the conversion start and indicate that we want this corridor. So we are going to be going to Arya's age, and we're going to specify that we do not want any Roth conversions calculated prior to age 67. And we're going to hit refresh. Now, one of the things that we also are looking at, and something that makes sense for them, is that they want to look at, and they're comfortable with at least, filling up to the 22% tax bracket. So we can use a slider to toggle to the 22% tax bracket. And once I hit refresh, what that's going to be doing is the system's going to be calculating how much we can convert and when we convert it to fill up to the 22% tax bracket. Now, of course, because I indicated that we do not want to have any Roth conversions calculated prior to age 67, we're not going to see those conversions happen as a result. So us tying that additional action item in allows for us to set further parameters and kind of a restriction when it comes to when we want to ensure we're meeting one of the client's requests that they've communicated to us. So now we can see how much more we're going to have in tax-adjusted ending wealth with just implementing the Roth conversion strategy. We can also see here where our adjusted taxable income falls with and without the conversion. We can see we're filling up that tax bracket, of course, over the years. But one of the very popular tools that we also have available to us is the strategies tool. This is where we'll find that solve for top strategies button. So we're going to click on this button, and what that's going to do is it's going to calculate the top 5 strategies based on tax-adjusted ending wealth. And it's going to be the culmination of the different parameters that we have indicated below. So it's going to be looking at the asset allocation strategy, withdrawal strategy, and Roth conversion strategy as well. And it will be considering that parameter that I indicated down below, that we want to ensure that there's no Roth conversions prior to age 67. So this is a dynamic calculation that's happening where we can see what those top 5 strategies are. We can see that there's a 3-way tie for the top 3. And we can see that that also kind of grants us additional options, at least for the tax smart withdrawal strategy. So the asset allocation strategy remains the same if we want to achieve the most in tax adjusted ending wealth. Roth conversion strategy, it's saying no IRMA. But withdrawal strategy, we have a couple different options, which provides us some additional flexibility. Now, this is a fantastic tool just to see what those different strategies can be to achieve the most in tax adjusted ending wealth. But one thing that's really important to note is that if we know maybe the no IRMA doesn't make sense for this family, maybe it's indicating down below the 24% tax bracket is going to provide more tax adjusted ending wealth. But maybe we know that the client's not comfortable filling up to the 24% tax bracket. That's when you can just toggle down below and indicate the actual path we want to pursue. So we can use that for reference. And let's say I do want to implement the equity allocation strategy. I can use the proposed strategy drop down from here to indicate that we want to toggle to the tax-free, taxable, and tax-deferred option. And then for withdrawal sequence, we have a lot of flexibility there. So we're going to leave it as is. And if we wanted to toggle to the other option for no IRMA, we can certainly do so by just going to Medicare premium tax bracket. And the first option here is for no IRMA. So this is going to be calculating how much we can convert, when applicable, of course, in order to not trigger IRMA or the next income-related monthly adjustment amount for Medicare premiums. So we're going to hit refresh. And then from here, we'll see how it starts to impact some of the other visuals that we'll find. Starting with the summary visual, we can see here a nice visual summary of the difference between our proposed strategy versus the reference strategy. And we'll see here how much more we'll have in tax-adjusted ending wealth, how much less we're paying in taxes, and also how much less we're pulling from tax-deferred assets as well. Now, once again, for additional reference, especially because we did just propose an asset allocation strategy, we can use the asset allocation drop-down to see, once again, for context, what the current portfolio allocation is and what the switch would be and what it would entail for each of the different tax exposed or tax advantaged buckets. In this case, we indicated we want to fill up the tax-free bucket first, then taxable, and then tax deferred with the equities versus fixed income. Under calibration, for reference, we'll find that additional tax bracket, but the comparisons visuals is going to be where we find a lot of additional key comparison visuals, as the name entails, starting with, once again, the difference of invested assets. And we will also see here the difference of just total ending assets at the end of plan between the two strategies, and also tax-adjusted ending wealth. So this figure right here is going to be considering the tax adjusted ending wealth. That is going to be considering our estimated terminal tax rate. One of the other key visuals we'll also find from this dropdown is the difference of federal taxes paid, because a really big question here we're answering for this client is, what's the total difference of taxes paid, of course? And in this case, we can, of course, guess that we're going to be paying higher taxes when we're doing the Roth conversions, for example. But overall, we're mitigating a larger tax burden post-RMD age, as we can see from here. One of the other visuals, and a big part of the reason why we're saving that money, is the RMDs. So we can see the difference here of RMDs as a result of these Roth conversions. And we can also see the difference of tax adjusted to ending wealth. So under tax adjusted to ending wealth, this is where we can see with our proposed strategy, that's considering everything we indicated below, how much more we have in the tax-free bucket. In this case, we have 65% of our ending wealth into the tax-free bucket, versus if we didn't do those Roth conversions or those other things, we're only going to have 6% of our assets in tax-free, which means we have a really large portion of the heir's inheritance in a very tax-exposed status. Whereas when you put it to mostly tax-free, we're saving them a lot of money when it comes to those taxes in particular. Now, this is also going to be looking at the tax-adjusted ending wealth, which means that that estimated terminal tax rate comes into play. So for example, if we toggle this to say a higher number, let's say we're looking at the 30% tax rate, once we hit refresh, we're going to see that that's mostly going to impact the figures we see up above, especially for our reference strategy, because it has the most in the tax exposed bucket. So that's going to be the most kind of negatively impacted when it comes to the estimated terminal tax rate, because it is going to be subject to that situation. So it's going to be tying in that estimated terminal tax rate into the tax adjusted ending wealth. In this case, we're going to toggle back to 22% and hit refresh. So that's going to be the difference of tax adjusted ending wealth right there. The next visual we'll see here is the difference of withdrawals from accounts across their lifetime, and also the difference of account balances as well. Now, one of the best places to go to see some of the insights or some of the logistics when it comes to the Roth conversions and these different strategies is going to be the details sub-tab. Because within the details sub-tab, we can see first the withdrawals and the conversions. And we can also see when we're doing those conversions, how much we're converting, and of course, when. And we can see here that we're not doing any conversions past age 75, which is fantastic. But let's say we're looking at this and we actually are having the conversation with the client and they let us know, hey, we want to ensure, and maybe we're more comfortable with doing more Roth conversions. We want to have more in the tax-free bucket. That's going to be our indicator that we can go back into, say, calibrations, for example, and back under action items. Let's say they're indicating that they don't want to do Roth conversions past age 72. So if that's the case, we can indicate a hard stop to that calculation by changing conversions ends to, say, Aria or Gendry's age, and we'll indicate age 72. Because if we don't indicate an end for the conversions, like we just did, the system's going to calculate Roth conversions whenever it's available and whenever it's applicable. So whenever we have the room in the tax bracket and the availability with the tax deferred assets to do the Roth conversions. So in this case, we're going to start to incorporate some of those other strategies. And let's say in this case, we wanted to indicate that we want to do that ordinary income tax bracket. And let's say we wanted to look at what it was going to be when we actually converted up to the 22% tax bracket. So we can hit the refresh button and see how it's going to change the conversation up above. So now we're going to see that we're, of course, filling up the tax bracket, so 22%. We can see how much more we're going to have in tax adjusted ending wealth. And that's just going to change some of the conversations we were having with some of the other visuals. But back under details, we'll then see now that we have a hard stop for the Roth conversions. We can see when we're converting it and how much more we're converting each year as well. We can also see the account balances for a different reference. And under the dropdown, we can also view the tax details. So this will provide us a nice check-in of where we're falling in terms of adjusted taxable income, total federal taxes paid, and also the different tax brackets as well. One of the other very important pieces of information we can find under details is the Medicare premium dropdown. This is where we can see, especially if we have the Medicare premiums turned on, of course, how much we're paying for Medicare premiums for Aria and Gendry. and also the Medicare premium thresholds and magi for each of them for reference. So we can see that for additional kind of context clues of what's happening in terms of us impacting the Medicare premiums, we can see that we, of course, have slightly higher Medicare premiums when we have those Roth conversions occurring. And that is considering the 2-year look back, of course. The final piece of information that's going to be important for at least one of the strategies we looked at today is the asset location summary. And this is going to show us the breakdown that we have across the different tax advantage and exposed accounts in the different buckets, what the current or overall portfolio equity allocation is, and how it falls for each of the different accounts. And we can also see what's happening across each year of the client's plan. Another really important thing to note is that we can drill into each of these column headers to see a further breakdown of the different equity allocation. And another thing that's important to note too, that I see a couple of you ask the question on, and it's a very important question to make sure is answered, is that we will be excluding unique products from the equity allocation strategy. So for example, some of those unique products are, of course, annuity products, inherited IRAs, 529s are another example of something that's going to be separated from that particular strategy. But for reference, you'll see for each of the different types of account buckets, what those types of excluded accounts are. But this is how we can see across the client's lifetime what that asset allocation is. Like I said, this is a dynamic calculation that happens per year. So it's going to be considering how much we have for each of the account balances per account over time, and also any fluctuations happening in terms of overall portfolio equity. I also want to note too, we can download this information into an Excel spreadsheet. So if we're wanting to have a different formatting of this report, we also have that available to us by clicking on this blue download icon right here. Now, another really important thing to note now that we have refined our first tax strategy is when we're ready to take the next step and apply this to part of our proposed plan, that is when we're going to navigate to the retirement module. So let's say we wanted to tie this into our proposed strategy. We're going to go to retirement and then into analysis. Here's where we're going to see the first gauge of financial well-being. This is going to be looking at that probability of success, which is looking at the Monte Carlo simulations or the 1,000 trials of market volatility. And it's a percentage of those trials that make it to the end of plan without running out of money. Now for the current plan, 100% probability of success, which is great, but we do have a lot of different paths we're looking at for the client. Of course, one of them being the tax strategies. So in this case, that's when we're going to start to leverage the action items, because the action items are what we use to create our proposed plans. And whatever we indicate here is only going to impact the proposed plans. It's not going to impact the current plan. And in this case, I'm going to be making changes to my Roth Conversions plan. So within the action items, I'd want to go to the strategy section on the right-hand side of the screen. And then instead of using the current strategy for tax strategy, I want to switch it over to the proposed strategy. Once I select proposed strategy, I'm going to hit refresh. And we're going to see how it impacts that probability of success. And in this case, still 100% probability of success, which is fantastic. But now we're also incorporating a very key part of the client's concerns and addressing them, which is putting a lot more money into the tax-free bucket, because we also want to mitigate not only just the normal taxes they're paying in the long run, but also making sure we have most of our assets in the tax-free bucket to alleviate the burden that their heirs are going to be paying. Now, this is just one of the key comparison visuals we can find here. The second comparison visual is, of course, the comparisons tab. Now, what we see here, especially in this instance, because we don't have much different between our proposed plan and the current plan, it's going to look very similar to what we saw in the tax strategies module. Now, under comparisons, we can see the difference of invested assets. Once again, the difference of a net worth, but also very importantly, the difference of total taxes paid. And we can see here for additional reference, how much more or less we're paying in terms of total taxes between the two plans. We can also hover over the chart to see the difference per year. Now, this is going to be especially beneficial as we start to build up more complex proposed plans versus the current plan or whichever one we have selected currently. Now, another thing that's going to be very important to note as we're looking at leveraging tax strategies, it's not unusual for us to have to adapt to different proposed plans. So in this case, we do have another scenario we're looking at with this family. So I'm actually going to toggle to one of my other proposed strategies. You can see here I already have a long list of different proposed plans. One of the other strategies that we're looking at is we're looking at a debt strategy plus downsizing strategy. So I'm going to toggle to that option right here. And we're just going to kind of walk through the different items that I have indicated down below and the difference between each of them. So something that's going to be important here is we started to further refine some of the different pieces when it comes to how much we're spending each month. This is actually something we're going to bump down because we had a different conversation with them. We can see here some of the different pieces, such as charitable giving. We also have tied in our debt proposal, a couple of other unique instances that we're also indicating, such as them downsizing and a couple other pieces. So this is going to be just an example of a dynamic strategy we're looking at. Now, one thing that's really important to note is we can, of course, tie in the tax strategy we just indicated. So that's going to be everything we built out in tax strategies. That's going to be considering that we're using that equity allocation strategy, and we're also filling up the tax bracket as well with Roth conversions. But in this case, let's say we wanted to also look at that idea of a different version of that tax strategy proposal. That's going to be unique to this one. That's where we're going to navigate back to tax and back into tax strategies. Now, going back to tax strategies, if we scroll down to the action items here and click on the edit button, this is once again where we can go to indicate what we want to include or exclude from the conversation today, but it's also where we go to create multiple tax strategies. So in this case, we just have the one, but what we're going to be doing is adding a new one. So we're going to click on add strategy. And from here, this is going to be strategy 2.0. But we can name this whatever we want to name it. That's just going to be the title for today. We'll hit the check mark to save the name change. One thing that I also want to note too is we can click on this 3 dots to either rename the strategy or copy off of this strategy to build from there. So if we wanted to copy off the original proposed strategy, we certainly could do so. And we can also delete it if it's no longer relevant. But now that we have created that additional one, we're going to hit save. And now when we go down to the action items, what we're going to be doing is we're going to toggle from proposed strategy from this drop down to strategy 2.0. Because this is now going to be the strategy that we're making changes to once we have that selected. So once again, one of the things that I want to provide an example of, and we can use this in a couple different ways, and I see somebody else has a use case that I'm going to back into as well. But in this case, instead of looking at my Roth conversions plan, we're going to use this drop down to toggle to my debt strategy and downsizing plan. Because that's just going to determine some of the conversation we're looking at from here. Now, in this case, let's say, for example, we're okay with everything we have indicated, but we still want to bake in that need that they have to make sure we're not doing Roth conversions before a certain point. So we're going to click back on that edit button real quick. We're going to hit conversion start. Once we hit save, we can now toggle on that we want to make sure that there's no conversions prior to age 67 in this case. Actually, in this case, we're going to look at 65. So we're going to hit refresh. And the first thing that I want to do is I want to go to the strategies tab, because this is where we can use that solve it button. And that's what we're going to do in this situation. We're going to hit recalculate here. And we're then going to see what options we have to achieve the most in tax adjusted ending wealth. And we can see here the different options we have available to us. In this case, it's saying the same thing for the equity allocation strategy, and we're comfortable with following that option. And in this case, we'd be looking at the 24% tax bracket. So we're going to hit refresh. And we're going to see how it's going to impact some of the visuals we see here. Now, in this case, for comparisons, we can see the difference of invested assets, the difference of federal taxes paid. Not surprising, we're going to have a giant hike in taxes when we have the Roth conversions and a couple other things, and also the difference of different visuals we have that we referenced earlier as well. So a lot more in this strategy is going to be in the tax-free bucket. So now we're going to have 86% in the tax-free bucket. We can see that difference of tax-adjusted ending wealth. And we can also see for additional reference the details. So now we can see if we go to details, how much we're converting and when. Obviously, it's a lot more significant of a Roth conversion we're seeing with the strategy. And we can also see the other implications for tax details across their lifetime, Medicare premiums, and asset allocation summary. And especially now that, we've decided that this is something we also want to see how it will impact this unique plan, we're going to navigate back to the retirement module. And when we go back to analysis, we want to make sure that that's the one we have selected on the left-hand side, that strategy and downsizing plan, which we do have currently selected. So we're going to go down to the action items and we're going to toggle on that strategy 2.0. So going to strategies and the tax strategy drop down. Once we select strategy 2.0, we're going to hit refresh and see how it impacts that probability of success. And we will also see how it impacts some of the other comparison conversation pieces as well. Now, keeping in mind, this is going to be for the debt strategy and downsizing plan versus current plan. So this is considering everything I have indicated down below. For my action items, we're going to see the difference in the blue text for additional reference, and anything that's new and proposed within this plan is going to have a green dot for additional reference. So now we can start to isolate and maybe make additional adjustments, because in this case, if we're looking at both retiring earlier, taking the debt strategy, downsizing and Roth conversions and a couple other things, we might be also looking at shifting a couple other priorities as well. Now, one of the other kind of questions, I'm going to be backing into a couple of use cases, but I want to first toggle over to one of the other important pieces of the final conversation for today when it comes to the Roth conversions and seeing the impacts of the tax strategies is going to be found under the retirement cash flows. So under retirement cash flows, this is where we'll find that secondary gauge of financial well-being. This is going to be looking at a straight line projection. And this is the same type of calculation we were seeing back on our tax strategies and also under the comparisons visuals. So it's very important to note different calculation than what we see under, say, the probability of success, which is looking at Monte Carlo simulations. So this is going to be the cash flows where we can see a lot of great insights when it comes to the client's financial well-being. First, we're going to see here this MAPS visualization, which is going to represent a specific year of the cash flow and a nice visual to kind of paint the picture of where our money's coming from and where it's flowing into. But what's going to be really beneficial here is first the summary tab, where we can see a further breakdown of the year by year cash inflows and cash outflows for this client's plan. And this is going to be something that's unique to each plan. So if I wanted to look at, say, just my Roth conversion strategy, I'm going to toggle to that one from here. And we'll see those unique cash flows populated for us. And this is how we can also see additional insights to see, of course, once they retire at age 67, since we're also not filing for Social Security, it's not surprising that we have a gap in income here. So we can see that we still have expenses that year, of course. We can see we have a negative net flow, which just means we're going to need to pull from our assets to fund these expenses. That's representing that negative net flow. And that's going to be something we also see under the accounts sub-tab. Accounts is where we're going to see a lot of the actual movement when it comes to Roth conversions or us pulling from these assets or withdrawing from them or also contributing to them as well. So starting under accounts, we can see the ending balance by accounts for each of the different types of buckets. And we can also click into each of the column headers to see a further breakdown for cash versus taxable brokerage assets and breakdown of ownership as well. But one of the other key insights we can also find is we can also toggle to additions to accounts. We can also see the RMDs and when that's happening, and also the withdrawals from accounts and net cash flows. So especially if we're looking at something like Roth conversions, where we're taking money out of the tax deferred bucket and putting it into the Roth bucket, we can also see that from here. So that's how we can see that movement as well. Now, before we dive into a couple of use cases that we're also going to be modeling based off of a couple questions, I want to first highlight the different resources that you do have available to you when leveraging RightCapital. So we go back to our advisor portal real quick. And if we click on our help button, that's just going to bring us to our help center. This is where you can find a lot of written guides or instructions regarding any sort of data entry. Also going to be another place to find written instructions on leveraging the tax strategies module. But you will also find here a lot of training videos and also a lot of webinars. So another question I see is if this webinar is going to be recorded. And the answer is yes, it is recorded. And you will receive the recording in a follow-up email tomorrow. But you will also always find here in our webinar section, all of our webinars are uploaded here for your convenience for viewing. So if you wanted to dive into this one in the future, you can do that from here. Same thing for a lot of other previously recorded webinars. If you're looking to take a deeper dive into, say, Social Security filing, debt management strategies, other case studies that we have, this is going to be a fantastic resource that you do have available to you. Now for live support, you go to Contact Us Support. This is just going to list out the ways we can reach out to our fantastic support team. One of the most present features is, of course, the chat feature that we can use to message the team directly for immediate assistance. We can also call the phone number listed here for immediate assistance as well. We can also email them if that's our preferred method of communication. And we can also book dedicated one-on-one sessions with the product experts. So especially if you have a longer list of questions, you have a more complex situation you're modeling, or you just want a second set of eyes to make sure the data entry is accurate, this is going to be a fantastic resource that you do have available to you as well. Now, one thing that I want to note, they do and are always happy to help you at any time, but their hours are going to be 9 a.m. to 6 p.m. Eastern. Because I see that's also a question. Perfect. So we're going to navigate back to the client plan. And like I said, I see we have another question, which is a fantastic use case to model. So we're going to go back to tax strategies. And then from here, so this is going to require a couple different steps, but somebody wanted to see what it would look like if we also had the no IRMAA. So they wanted to see and create a third strategy here with no IRMAA. So we're going to go down to the action items and click on the edit button. We're going to click on add strategy. Let's say this is no IRMAA. We'll hit save. And now the most important thing is I want to make sure I have that strategy selected on the left-hand side, because that is the one that we're going to be changing when we make the adjustments down below. And let's say in this case, we want to really just isolate the withdrawal strategy and Roth conversions. So we're going to deselect asset location. And this is also just to provide an example, because I see a couple of you also asked about what if we don't want to deal with the asset locations? What if it's something we're not touching on with the client? Is the calculator going to also consider that implication? The answer is yes. But for an example here, we're going to change our conversion target to Medicare premium tax bracket, and we're going to toggle to no IRMAA, and we're going to hit refresh. And we'll see how it starts to impact the plan up above. So you can see the difference of tax adjusted ending wealth, how much less we're paying in taxes, how much less we're pulling from tax deferred assets. Now under the strategy section, we can also click on the solve for top strategies button. And like I said before, this is a dynamic calculation that's going to consider whatever strategies we have indicated below. So in this case, I've removed the asset location strategy, which means that now we are just looking at which culmination of these two strategies can we take to achieve the most in tax adjusted ending wealth. In this case, Roth conversions up to 24% is the one that's going to achieve the most. And we have a couple different options when it comes to tax smart withdrawal strategies. So if we wanted to implement that, we certainly could. This case, for example, we're going to keep it to no IRMAA. But now that we have the no IRMAA indicated, if we wanted to tie that back to an alternative proposed plan, we're going to go back to retirement analysis. And another question that I have, and this is going to be relevant to also what we're modeling currently, is how to create multiple proposed plans under the retirement module. So in this case, what I'm going to be doing is we're going to be going to, once again, retirement analysis. We're going to click on the pencil icon, and that's going to open up a drawer that allows for me to add or modify my proposed plan titles. So in this case, we have two different options in front of us for how we can create an additional proposed plan. So the first option we have is to add new plan, and just click this button. What that would do is it would copy the current plan and allow for us to build from there. But we also have the option to copy any of our pre-existing proposed plans and build off a branching path off of that one. So if that's what we're looking to do with the Roth conversions, in that case, this is exactly what I'm trying to do. I'm going to select copy, and then further down, let's say I just want to put this as 2.0. Maybe we're titling this no IRMAA. We can click on the check mark to save the name change. We're going to hit OK. And then from the drop down on the left-hand side, really important distinction there, we're going to select Roth Conversions 2.0, because that is the plan we're going to be modifying in the action items down below. So now I'm going to be going over to tax strategy, and as opposed to having proposed strategy selected, we're going to indicate no IRMAA. and hit refresh. And we will then see that difference of probability of success and the difference of the proposed plan versus current plan. But we also can start to toggle and see the difference of the different proposed plans as well. So maybe we're also looking at the two Roth conversion situations. You want to have them side by side. You certainly can as well.